Hi there, my name's Nick Stenger. We are the Stenger Family Office. For the past 42 years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Here we are, it's February 13th, 2024. The market is having a pretty serious down day, down 2%, a little bit bigger than we've seen in recent history. Not a reason to panic. And this is a market minute video to remind you, yes, stocks are volatile. Don't forget that. When you're in the stock market, remember, stocks don't go up in a straight line forever. And we've gotten used to this the past couple of months now as the market's rebounded. It's made all-time brand new highs. The Dow's over 38,000 points. The S&P hit 5,000 points just a few weeks ago. And it's hard to remember that sometimes stocks don't go up. Now, most of the time they do. And that's what the doom and gloomers don't want you to know. They don't want you to know that most of the time stocks go up. And so, like I've reminded you on the weekly show that we do, if you had to flip a coin and pick a side to be on, optimist versus pessimist, doom and gloomer versus buy and hold, and stay on your plan, you'd always want to be an optimist, because on a year-to-year basis, the market goes up about 75% of the years. On a day-to-day basis, the market goes up about 51 to 52% of the time. So you almost have a 100% chance that if you keep your money in the market for about 5 years, is the statistic, that in 5 years you will have made money. So do not panic. Don't let this throw you off your plan. Don't let these little corrections and declines make you nervous. I think actually a lot of people right now are taking some profit. There are stocks like Nvidia that are up 45% year to date for 2024 in just a couple of months. That's called a little much too fast, a little bit too fast that the stock has gone up that much. And Nvidia may very well end up 45% for 2024. But in the short term, we may have to see a little bit of a correction, a decline, before it continues its upward ascent. And so the reason why stocks are down today is partly because people are taking profit, but also because there was a hotter than expected inflation report. CPI was up 3.1% last month in January versus what the analysts and the economists expected at 2.9%. So again, not the end of the world, not doom and gloom, but it was a little bit more than people expected. It was all driven by dining out. You've probably seen this. You go out to eat to a restaurant, or you go to the grocery store, and you've noticed that your bill is much higher than it was a few years ago. And so you used to be able to get a burger, for maybe $8, a burger and fries at a nice restaurant. Well, it's like 15, 16 bucks now. It's pretty surprising. There was a report the other day that a Big Mac meal at McDonald's is like $18. And so some of these costs are here to stay. Some of them may come down eventually. And so I believe we're at the peak level of price hikes. Well, are we going to see prices go down substantially? Probably not. And that gets into housing. That house down the road from you that sold for about 40% more last year, or even this year, than it did in 2019, is most likely not going down 40% anytime soon. It may go down 1 or 2%, or maybe even 10% in a correction, but it's not going down 40%. And so the question that I really want to answer today is, does the hotter than expected inflation report really matter long term? My short answer is no. And the reason why is because people are still doing very well, consumers are very strong, and businesses are also very strong. Remember, there's two sides of a stock's price. It's the earnings that a company makes, its profits, multiplied by what are those earnings worth in the future. That's called the PE ratio, price to earnings ratio. And so if you multiply the earnings multiple by the future earnings, then we're getting a expected stock price, what the company should be valued at. So in the short term, if inflation's a little bit higher than what economists thought, it basically makes people think that the Fed is going to stay higher for longer. They may keep interest rates, at the 5% range or 5.5% range, rather than getting back to where they really should be long term, which is about 2.5%. And so what happens to a stock's price when interest rates are higher is, in the short run, those earnings can be valued at a lower multiple than they would be in a low interest rate environment. And so when we had 0% interest rates during COVID, there were stocks, especially tech stocks, that traded for 50, 100, 200 times earnings. There's some of that still in the marketplace today, but a lot of it's gone. A lot of that's weeded its way out, and stock prices are back to reality. We had that correction in 2022, you'll remember. We even had a little bit of decline in 2023 at the end of last year, but most stocks, if you look at the S&P 500, we're trading about 20 times earnings. And so at some point, the question is going to be, is 20 times forward earnings on the S&P 500, large US companies, the right price to pay? Or are they overvalued? And I would argue that they're not overvalued. They're definitely not undervalued, but I believe stocks today are fairly valued. And the reason why is because companies today, especially the best companies, the biggest in the S&P, are sitting on mountains of cash. They have no idea what to do with their cash. They are maybe looking at buybacks and dividends. You saw Facebook is paying its first ever dividend. It's never paid a dividend before, which is pretty historic for a tech company to be doing. It means they're sitting on cash and they don't know what to do with it. So they're going to pay you as the shareholder instead of leaving it in the business. That's a positive thing if you're an investor. And so we're going to see more of this, where the biggest companies, I believe, will continue to outperform the smallest companies, especially if rates stay higher for longer. So what's the implication for investors? Well, obviously, the doom and gloom scenario is that rates stay much higher for much longer, or even rise. If rates rise, the market will correct substantially, and we could see a 30, 40, 50% decrease. I don't think that's going to happen. I think instead what we're going to see, and this is what we've been arguing for the past couple months now, is that inflation is going to remain stubborn and rates aren't going to come down at the pace that people want, that certainly investors would like to see. And so the implication is we could see some volatility here this spring. Don't be alarmed. Don't be surprised. Don't be shocked if we see the stock market, the S&P, trade off 10% or 15%. That's a normal correction. That's part of the process of owning stocks. But by the end of the year, go back to that PE ratio, price times earnings. The earnings will ultimately decide where stocks end up. If companies are doing well, if they're profitable, if they're making more money next quarter than they did this quarter and showing great future growth potential, then stock prices will rebound, the correction will end, and eventually will go on to make new highs. So stay bullish, stay optimistic. I think companies are going to be fine. They're sitting on mountains of cash. They don't know what to do with it. We've got investors sitting on the sidelines, all the people that have been bearish and doom and gloomers and worried about the sky falling for the past 3 years. Some point here, they're going to get some cash to work. So we're going to see that be a positive. But really, at the end of the day, companies, I think, are going to produce higher profits. The second piece to all of this is the Fed is being very, very careful with the labor market. You've seen lots of layoffs being announced. And if you've been watching the show every week, if you've been listening to our stuff that we put out and our articles and all the rest of it, I've been saying, watch out, layoffs are coming. UPS announced 12,000 layoffs. A bunch of other companies have announced substantial layoffs. I think Citibank is in the 20,000 zone, which is substantial. You're going to keep seeing this. And what the Fed is worried about is triggering mass layoffs. So there's a steady tightrope, a very thin tightrope that they're walking right now to decide if they want to keep rates high and risk mass layoffs, unemployment rising past the 5% zone, or if they're going to back off a little bit. And I believe they're going to back off. It just is a matter of time before they make that decision. But I believe they want to go down in history being loved rather than hated. And well, we've seen Fed chairs basically go with the flow, so to speak, and they do want to be loved in the history books. I think Powell is going to cut rates. Just be patient. It's just going to take some time. And when that happens, it'll be too late to respond. When rate cuts are announced, you're going to have to be in the market because stocks will go right back up. And I believe we're going to finish 2024 at levels that we've never seen, record all-time highs. So stay bullish, stay on your plan. Don't be spooked when these 2% corrections happen. By the way, we're going to see more. We are going to see more volatility this spring. Don't be alarmed. Remember that we're warning you about this today. Stay on your plan. And if you've got cash or you've got the ability to rebalance and you're doing it on a goals-based plan, talk to your financial advisor. If it's us, talk to us, and we'll rebalance. We'll get you back into the market with some of the cash that we've been holding for a rainy day, for example, or some of the treasuries where we've been waiting for a rebalancing opportunity. That's the time to buy. When everybody's panicking, when everybody's nervous, that's when you want to be an optimist and be bullish. So stay the course, don't panic, and we will keep you on your plan. Listen to the shows that we put out, read the articles. We'll keep you updated. We should have another show coming out this week. We'll be back to bullish in a few weeks. Watch those on YouTube. Thanks for listening. We'll see you next time for another episode of Market Minute.